Welcome back to EDS, and in this video I'm going to show you how you can write your own options contracts, collect a premium upfront and generate consistent returns year on year. So the first thing you want to do is open any equities underlying in your brokerage platform. You've just got Netflix open, any equity, it doesn't matter, and you want to navigate over to where you can see a list of expiration dates for that underlying. Now, all the expiration dates for all equities are the same. This is why it doesn't make a difference. The purpose of this is we just want to see how far out we're going to be on the contract that we're going to sell. So we want the one that we lock in on needs to be between 30 and 60 days out in time, and it also needs to be a monthly expiration date, not a weekly or quarterly. Now, the only one that actually fits that criteria right now is February 21st, with 60 days still left on the contract. January 17th would be a little bit too short for us, coming in at 25 days. So February 21st, this is called the back month, with 60 days left on the contract. So we're going to take that information, come over to our watch list, and simply filter out any and all underlyings that have earnings over that given time period, which in this case is 60 days. So we just want to open this and filter out anything that has earnings over the next 60 days. The reason for this is because an earnings event increases volatility coming up to the event, and then after the announcement, the volatility comes out of the market. However, that volatility comes out of the market, and generally speaking, the market moves in either direction, and that can cause problems with our deltas. And whether volatility increases or whether our deltas get messed up, both of these things or either of these things will have a negative effect on our P&L. So we just want to avoid that. We can do earnings plays, but that's a completely separate thing. And we also want to filter out anything with a low liquidity rating level. So we only got very liquid markets that we can trade available to us on our watch list. The reason for this is because the more liquid a market is, the tighter the spread is. The spread is the difference between the bid and ask. And the spread is what you pay when you get into a position and when you come out of a position. So the tighter the spread, the less you pay. And to get a tighter spread, you need a more liquid market. So that's why we do that. At this point, I personally like to order everything from high to low IVR. Remember, we are shorting these contracts when volatility is high, option price is high. So you want to sell high, buy back lower. And so we use IVR to tell us where volatility is, or where implied volatility is relative to itself on that given underlying over the past year. And we want to keep in mind what's already in our portfolios, and we want to make sure that anything that we are looking to trade is going to complement our portfolio nicely. Keep everything nice and diverse. Use common sense. You can use beta weighting. You can use correlations to the SPY. However, that all of that isn't necessary. Just use common sense for the most part. You'll be completely fine. So, going down the list straight away, I'm looking at XLF here, which is the financial sector, and it's currently trading at just under $50, or more accurately, just under $48, with a very nice IV rank of 76.7 and an absolute IV level of 21.7. Now, XLF is an ETF, which means that there is no company risk, which means that our P&L will typically be smoother. We'll collect less premium on entry because we don't have the company risk there. However, over the long term, our P&L will be much smoother with an ETF as opposed to an individual company. So XLF, let's just take a closer look at XLF. Let's pull up the options or the list of expirations for XLF, and we already know the expiration date that we're going to choose, which is February 21st, 60 days out in time. And this is now the options chain that we are presented with. The orange horizontal bar, shows us where price of XLF is with respect to the strikes. And the vertical orange bar shows us what the expected move is of XLF over the next 60 days. So what we want to do is what we always do, which is simply just sell one call and one put. Very simple, very lightweight. Um, and that's basically it. We want to sell outside of this expected move so that we can get a high probability of success, but not too far, so that we go past the one standard deviation mark, because then we're typically going to be leaving money on the table. So one way that I like to make sure that we're not too close and not too far is by using delta. And anywhere between a 15 and 20 delta will do. This is a 21 delta here at the 51 strike, and we've got a 21 delta on the put side at the 45 strike. So if you notice, our contracts that we're selling are outside of the expected move, not too far outside. They're not outside of the one standard deviation mark. And this green bar here shows us the break-even points on this position, which far overshadows the vertical orange bar. And what that's going to lead to is a high probability of success. As we can see here in the bottom left corner, we have a probability of profit of 65%, which means that at expiration, we have a 65% chance of making at least 1 penny on this position. And there is if we want to take profit at 50% of max profit, we've got about a 87-88% chance of being able to do that at some point over the next 60 days. So we are looking at some very, very high probabilities of success here. If we want even higher probabilities of success, we could just go down to the 15 delta and the 14 delta, and now we're looking at a 92% probability of profit, of hitting 50% of max profit over the next 60 days. However, we do suffer in premium that we collect up front by doing this. So we're just going to go back to the 21 delta so we can collect a bit more premium here. And as we can see, we would collect 87 cents. That's per share. There's 100 shares per options contract. So there would be 87 cents times 100, which is $87. So we would collect $87 straight away on this position as soon as we get filled. Now, our broker is going to require $667 in buying power to open this position, which gives us a pretty nice and decent return on capital here, as we can see, especially for it being a naked position. Now, if we wanted to reduce this buying power requirement or get rid of this unlimited max loss potential, what we could simply do is just buy another contract a little bit further out. So let's say if we just bought another contract, say $2 out from where our short is, and we do the same thing on the put side, what we've now done is we've created a $2 spread in between our strikes, and that has now defined our risk, that has defined our max loss. And our max risk or our max loss is now defined as whatever the spread is in between the two strikes, which is $2, minus the premium that we collect up front, which is 48 cents, times by 100, and we get $152, which is our max loss. Now, our broker knows what our max loss is, and it only therefore requires whatever our max loss is in buying power. So our buying power requirement has now significantly been reduced right the way down from $667 all the way to $152. And if you notice now, we have a much higher return on capital now on this position as opposed to the naked position that we were looking at before. We do have slightly lower probabilities of success, but only by a couple of points, not by much. And in return, we enjoy a much higher return on capital. Now, this is an example of how you can find and manipulate positions to fit inside your portfolio, no matter what size portfolio you have. If you had an even smaller portfolio, you can just shorten the spread or make the spread smaller. If you have a larger portfolio, you can simply make the spread wider. And how do you know how much buying power you should be allocating to your positions? Well, in order to figure that out, we've created a free position sizing template that's free for everybody to use and get a hold of. The link is in the description. The way it works is you enter in the size of your portfolio. Let's say if it's $5,000, you then enter in what the current VIX level, which last time I checked was just under 19. Everything below will then be automatically calculated for you. And at this point, all you need to do is simply use this information to form the backbone of your portfolio. It will tell you the maximum amount of buying power you should be allocating to any single defined risk position undefined risk position, and how much of your portfolio you should be allocating to short premium strategies in general. And as long as you're doing this and following this guideline over the long term, you will be absolutely fine. If you want to learn in more detail about what we do and how we do it, again, link in description. This time, click on EDS Premium. Get yourself signed up. Inside, you'll have access to our portfolios that will allow you to see what positions we're placing, how we're managing risk, how we're making adjustments, all in real time. There's a full course, so no prior knowledge is required. We will teach you everything that you need to know from start to finish. There's a private community. It is a private community, so if you ever get stuck, you can speak with myself directly or with other like-minded individuals. There's a 100% money-back guarantee as well. So once you have studied our full course and followed our trades for at least 6 months, if at that point you haven't been profitable, then we will work with you for free until you are, or you can simply request a full refund. So it's completely risk-free on your part. And right now, it's £1 a month to join. The price will be increasing. It's so cheap right now because we've just launched, so you are definitely rewarded for getting in early. And the goal of EDS Premium is to get you to a point where you're completely self-sufficient and you know what to do, you know how to do it, you've learned the skill, and it's something that no one can ever take away from you for the rest of your life. We want to get you to that point in 6 to 12 months. You're always welcome to stay and be a part of the community, but 6 to 12 months and you should be good to go. So with that being said, I'll see you guys on the inside.